This is the Economic Review. Stanchart Bank, Kenya, made a bold move Thursday last week to announce a 10 shillings and 50 cents dividend payout, which will be 16% lower than the 12 shillings and 50 cents that was paid out last year by the Tier 1 lender. Now, the lender, who saw profits for the year ended December 2020 decline by the 3.9% to 5.44 billion shillings from 8.24 billion, becomes the fourth to issue dividends despite a fall in profits, saying the decision was informed by strong capital buffers. While announcing the decision to pay, Stanchart CEO Kariuki Ngari said, and I quote, "The board recognizes the importance of dividends to shareholders and believes in balancing returns with investment to transform the business for the long term, while at the same time preserving strong capital ratios." And quote, Stanchart attributed the fall in profitability to flat net interest income and a 6.7 times rise in loan loss provision, which shot to 3.88 billion shillings in appreciation. All these occasioned by the economic effects of the COVID-19 pandemic, according to the lender. Joining us this morning to go through this issue, we're joined by Paul Nganga, who's a banking expert, and also Arnold Ngasale, who's a microfinance banker. Just before we cross over to Paul this morning, let's look at exactly what has been the 5-year profitability trend for Stanchart all the way from 2015 to 2019. There you can actually see exactly where they stand, with 2016 being their best year in terms of that profitability trend. All right, let's look at what were their key selected performance indicators as of Q3 over 2020. You can actually see there that profits after tax went to 4.3 billion, all the way from what was their total interest income of 17 billion, all the way up to that level. Good. All right. Now, let's cross over to Paul this morning. Now, Paul, Stanchart becomes one of the lenders that have paid one of the highest dividends at a time when most of the banks in the country are expected to either cancel their payments or have already drastically revised them downwards. Well, if you look at the key performance indicators for the lender, what is behind this healthy dividend payout?
Thanks, Elijah. Looking at Stanchart's results, they have actually done pretty well if you look at it.
Yes.
Even if their interest incomes have been flat, you note that their provisions have gone up significantly, but only to 3.8 billion. If you look at that quantum compared to other banks, they have done relatively well. Now, Stanchart has been one of the most conservative banks that we have in the industry. So, with them being this conservative, they have always done what we call, like, on averagely well.
Yes.
Throughout the year, consistently. So you find that the investors who invest in a bank like Stanchart are investors who are after dividends. They're not after capital gains, but after dividends. So you find that banks like Stanchart, which do conservatively well, year in, year out, must maintain a certain level of dividend this time.
Yes.
They are given a dividend level that will actually be what their shareholders expected. The shareholders, I would think, are typically much older than, say, the investors of startups. So they're relying on dividends, maybe for funding their retirement or something like that. So dividends is very, very important for Stanchart shareholders. Now, again, a company can only give dividends when some things are in place, especially for a bank. First of all, capital buffers must be maintained, because you don't want to give dividends this year and request for capital injection next year. So one of the things that you must have before you issue dividends, even before central bank allows you to give out dividends, is that you must have strong capital buffers, which Stanchart has. The next thing is that you must have free cash. Stanchart has a lot of free cash. They've typically been investing in government bonds much more than lending. So you find that their assets are quality assets. So you find that their risks are much lower.
Yes.
A third point is that Stanchart does not have very high liabilities. If you look at the liabilities side of their balance sheet, 98% of their liabilities are deposits from customers or deposits from other banks.
Yes.
So non-deposit liabilities for Stanchart are less than 2%. So these guys, they're typically very well funded, and they don't have so much financial leverage. So that makes it also a very safe bank. And you see year in, year out, you'll find that they will make good dividends. So basically, with those factors, you find that the CEO basically had no choice. He had to maintain a good dividend payout just to make sure that the expectations are maintained.
Yes.
of his level of shareholders. Yeah, so that's why I think that they gave out very high dividends, and like many other banks who will actually cut their dividends or reduce them significantly.
Pretty much. Now, let me bring in Arnold, because Paul, I'm going to come back to you on whether really Stanchart has met what is the central bank is calling an adequate capital buffer ratio, because that's exactly what we've seen banks like ABSA go on to cancel their dividend payout. Now, Arnold, I mean, look at what the CEO is saying. The CEO is saying that we recognize the importance of paying out a dividend right now within the coronavirus pandemic. But over the other side, the CBK is saying, well, before you pay out those dividends, you got to come to us so that we can give you the green light to continue with that dividend payout. Arnold, how important is it for a bank now to continue paying the dividends to investors right now?
Thank you so much, Simba. First of all, I think Paul has intricately extrapolated Stanchart's position.
Yes.
And probably just to add, I think it's all about investment. One of the highest paying stocks in the market. And you wouldn't imagine either drastically cutting or not paying dividends. I think when you look at the dynamics of Stanchart, apart from being conservative, as Paul has mentioned, they're big on correspondence banking. A lot of banks do a lot of international correspondence with Stanchart. So it's essentially a very stable and very safe bank. And then if you again look at their financials, I think part of the reason as to why they posted less income as compared to last year was some staff cuts, some voluntary retirement program, and then at the end of the day, they simply increased the wages of the existing staff. So that balancing act, essentially, it's supposed to marginally reduce on the operating cost of the institution,
yes.
But to some extent, it ballooned. If you look at the figures, I think we're talking about 500 million worth of staff cost, and I think as banks were doing a juggling act of doing provisions, reorganizing their business amid COVID-19, part of an overhead cost. And I think for them, they slightly missed it when it came to the staff cost. But generally speaking, I think they made the right call. At the beginning of the month, CBK were very categorical in advising banks not to pay dividends unless they had met the adequate capital ratios. I think for Stanchart, they're okay as far as that is concerned. You realize also Stanchart, apart from local investors, they have a lot of foreign investors.
Yes.
And for them, investor confidence is key. You can't drastically cut those dividends. And I think from where the CEO sits, it makes sense long term to pay those dividends.
Right, Paul, let's get back to that conversation therefore, because, well, the CBK is quite adamant that, well, they're not going to really give it just a free way for banks to decide among themselves whether they're going to pay these dividends or not. They're actually pushing these bank CEOs to attain a certain level, which is not disclosed yet in terms of capital adequacy, because we do know right now that if you look at exactly when we're talking about how banks are adequate right now in terms of those capitals, it's actually 54% adequacy right now, which is a level that was seen back in 2017. So from where you're seated, Paul, is the CBK being too strict on these banks? Should the CBK just let it for the banks to just, well, decide among the boards whether to pay these dividends or not?
Oh, thanks, Elijah. Yeah, that question is fundamentally why the central bank exists. The central bank exists to protect the nationals or the people banking in these organizations.
Yes.
So basically, the security of the depositors in a bank is the money that the owners of that bank have put in. That is the share capital. So basically, the central bank has a right to actually make sure that before any bank pays their dividends, it means before any bank pays dividends, they must have adequate share capital, of course,
yes,
and they must have sufficient buffers. And these buffers are calculated based on the risk profile of these banks. The risk profile meaning that the variability of different things, variability of liquidity ratios, variability of their foreign exchange exposures,
yes,
variability of their loan book exposures. So all these variabilities must be built into the buffer, the capital buffers of the bank. So if these variabilities can adequately be covered by the capital buffer, then central bank will allow you to pay dividends. But if central bank sees that if your, say, foreign exchange exposure is increased by 10%, it will wipe out your capital. Central bank will not give you the right to pay the dividends, because you may pay today and tomorrow you start asking for capital, or your capital is wiped out because your loan book goes haywire.
Yes.
And that's what we're going to see this year. We have done a lot of restructuring of loans. It was said that about a third loans were restructured in this year, 2020.
All right, Paul, let me just stick with you just a little bit.
Central bank will not allow you to restructure loans.
Yes.
Those loans which have been restructured cannot be restructured next year. The third wave has come. It takes time.
All right, pretty much. Paul, if I may...
Yes, I can hear you.
Yes, Paul, if I may stick with you for just to get back to that. I mean, Paul, we do know that what we're talking about here is just a law change this year, because we know that law does exist, that you can't pay out a dividend if you actually don't meet those capital buffers. But what the CBK is asking this year is extra scrutiny of higher capital buffers again that you gotta meet for you to actually get to pay this dividend, which is why we are asking, are they being too domineering at the time when these investors also need these dividends now?
Okay, sorry, the central bank is just doing their job. They must ensure that those extra buffers for the extra risks are met.
Yes.
But again, as you know, this is a special year. Banks, the first responsibility of banks is to stay alive. So the second responsibility is to their shareholders to give a dividend. So it's only after the first responsibility of the bank is met that a second one can come in. And that's what central bank is saying. So I don't think central bank is actually being being too strict on that.
Yes.
They are actually doing the right job.
Pretty much. All right, Arnold, the same question to you. I mean, it's a law change now that, as opposed to making that decision within your board, the final clearance has to come from the CBK. Is it necessary now?
Yeah, I think now more than ever it's necessary. Reason being,
Yes.
the CBK governor has from time to time assured the economy that we have a robust banking sector.
Yes.
And the reason as to why that is the case is because of the importance the banking industry plays in the economy. Last year, as we all know, was a special year. It was dark horse kind of year. And for this year, I think it makes sense. It makes sense for the CBK to monitor your cash reserve ratios, monitor your capital adequacies before, and essentially look if you've done stress tests. Ideally, for now, if you're running a bank, it would be able to run a couple of stress tests just to see what would happen in the event different scenarios take place. At the beginning, and most of us were very optimistic as far as the banking industry and 2021 was concerned. But with the advent of the third wave of coronavirus, a lot has changed. A lot of dynamics are changing right before our very own eyes. So it's prudent for banks to adhere to what CBK is talking about before paying out dividends. I think it's a juggling act. The reason you pay out a dividend as an entity listed on the stock exchange is for investor confidence and also for purposes of reimbursing your investors on the gains that you've made.
Yes.
Now, if you don't pay dividends, you risk, as Paul has said, you have probably done a couple of stress tests just to see if you have enough buffer to absorb any economic shocks, and then probably you can pay out your dividends. So it makes a lot of sense, and I think it's for the good of the banking industry and also the economy.
All right, Paul, clear for us this conversation this morning. Therefore, we've seen exactly what have been the results of a majority of the banks that have already given us their end year results. And we've seen that deep in profitability. Every bank is announcing it. But was that expected? And how do you summarize the performance of the banking industry so far, going by what we've seen from these results? Paul, can you get me? Can you confirm, sir, you can get me?
Yeah. So far, from what we've seen, it looks like banks have been quite resilient. Okay. Yeah, banks have been results that have come in. However, not all the results have all the results of the banks, because definitely some banks which will not do as well as well as others. So there's one analogy, and what is the main source of revenues for banks? If your biggest source of revenues is interest income, then you're going to have a bigger hit than those banks whose main sources of income is transactional income. You find banks which have leveraged significantly on transactions have a higher level of variable costs and a lower level of fixed costs. So those banks are going to do very well in 2020 and possibly much better in 2021. More better than those which haven't leveraged on technology significantly. In that year.
Pretty much. All right. Paul,
I think that's what I would see in based on the bank's results in 2020.
Pretty much. Paul Nganga, banking expert. I'd like to thank you very much for joining us this morning here on a Metropol television. We take a short break. Once we come back, we shall continue this conversation with Arnold Nkasale. Top on that. Why is the housing finance share really and valuation in the market increasing after Britain announced their plans to sell a stake in the company to a bigger bank in the economy? And finally, can we have a way for the expensive fuel prices in the economy once we come back?